Jay, in the last 50 years, there have been three big technologies that have had a big impact on the IPO market. You have the personal computer revolution in the 1980s, the internet in the 1990s, and then AI today. What are the differences between those three eras?
With personal computers, much more competitive market. There were dozens of personal computer hardware companies that went public. In the spring of 1986, Oracle, Sun Microsystems, and Microsoft all went public within 1 month of each other. And there were scores of other software and hardware companies going public then, as well as in the years before and after. Most of the companies have faded away. Most of them suffered in terms of profit potential from being a very competitive business. Apple went public in December of 1980. It was a highly anticipated offering. The stock price jumped up 30% on the day of trading. And over the next 3 years, Apple had a negative return. Indeed, for its first 22 years as a public company, Apple underperformed. Since 2022, it's been a different story with the iPod, iPad, iPhone, where they've resulted in tremendous success. And Microsoft and Oracle have certainly been incredibly successful companies as well. In the internet bubble, there were hundreds of companies going public. The mantra at the time was first mover advantage. A lot of people correctly thought various niches would have a winner-take-all aspect to them. Amazon went public in 1997 and has been incredibly successful. Nobody knew that Amazon Web Services would eventually become a major source of profits. And a lot of those companies faded away. In January of 1999, a little hardware company called NVIDIA went public. Was also greeted very positively by the market, jumped 60% on the first day of trading to a market cap of almost $600 million. Now it's close to $5 trillion. Most of the internet bubble companies had a fairly swift demise. Pets.com, one of the more noteworthy rapid collapses, as in venture capital, and for that matter, movie production, songwriting, writing books. You get a very skewed distribution of outcomes, lots of failures, and hopefully an occasional blockbuster. This is where venture capital in the United States has been pretty uniquely successful, even though venture capitalists invest in all sorts of startups where they know the most likely outcome is going to be total failure. There have been enough 10 baggers, whether it's Facebook or NVIDIA or Google, more recently Anthropic, OpenAI, that have resulted in the average returns being very attractive, even if the median deal is minus 100%. And this is where Europe, most of the rest of the world is envious that they just haven't had enough 10 baggers to offset the many losses. With AI right now, there are enormous upfront costs for developing a large language model, some of the associated hardware. So we're not seeing huge numbers of companies having lots of money spent on them with a high probability of failure. Some of these companies, they're still following the first mover advantage idea, but it's pretty clear who some of the big winners are going to be right now. There's a reason that private and public markets are giving valuations of roughly $1 trillion to OpenAI, Anthropic. Google's Gemini is certainly one of the reasons why Alphabet's valuation has gone up to $4 trillion as well.
Jay, how much of the story comes down to network effects when you reflect on these three eras? Do you think we're increasingly living in a winner-take-most kind of scenario where being number one is disproportionately valuable?
This is where tech is indeed different from other industries. The restaurant business is competitive. If you're not making money now, when are you going to? Not all of the verticals, the narrowly defined industries in the tech space have a feature where it is winner take all, or where there are really big economies of scale or ecosystem effects, as with Apple, that result in a handful of companies having a dominant market position, where even if they spent huge amounts of money up front and went through many years of losses, have then been able to make enormous profits later on without competition eroding those profit margins. That's where tech is different. But with network effects, where Google's search engine, Microsoft's software, where you and I can exchange PowerPoint slides and Excel files with anybody all around the world, we do have some areas where there's a network effect or really big economies of scale and expensive, complicated technologies. Building big commercial airplanes is really complicated. Airbus and Boeing have been able to do it. Nobody else has. Airbus and Boeing aren't especially profitable. They keep fighting for market share. Companies like NVIDIA, where they've got really great technology, as long as they stay a step ahead of the competition, there's a really big addressable market there, and they're capitalizing on it.
Hey, founders and finance folks, you know how early on everything is fast and scrappy, and then suddenly equity gets messy? Spreadsheets break, grant docs pile up, lawyers are sending new forms and collecting fees. It all shows up right about when you're already swamped. Well, if managing your cap table feels like one more frustrating thing on a very long to-do list, you need to know about Pulley. Pulley makes equity management simple and stress-free. You can issue options, model dilution, complete 409As, and more, all in one place with support from real experts when you need it. So if you're raising, hiring, or scaling, Pulley keeps your cap table clean so you can stay focused on building, not wrangling spreadsheets. Learn more, request a demo at pulley.com/mostlymetrics. That is PULLEY.com/mostlymetrics.